When I first bought the business, everything was on paper, pen, calculator. It was very time consuming and it just didn't make any sense. So I talked to my accountant and they got me hooked up with QuickBooks, and QuickBooks has been a blessing. And then we also went to software within the salon too, which tracks a lot of our numbers for us.
Northern Initiatives is committed to entrepreneurs like you because you are the people who are creating jobs and enabling the communities of our region to thrive. After completing this training, you will be able to explain the concept of financial management and why it's important to a small business, understand the value of selecting and correctly setting up accounting software, understand the importance of timely and accurate bookkeeping practices, and understand the basics of financial reports, including the income statement, balance sheet, and cash flow reports.
Quality financial management offers many benefits to you as a business owner. Financial management includes bookkeeping, projections, and financial statements, which forms the foundation for reaching your goals through sound business decisions. Financial management is one of your main avenues to success as a business owner. It's how you know if you're making a profit. Financial management helps you decide what you can afford in terms of store or office location, inventory purchases, employees, and equipment. You need sound financial information to set your prices and select your vendors. Financial management gives you the tools to plan for overall business growth, for diversification of your product lines, or for reaching new markets. Financial management helps you decide which products, services, and markets are profitable. Effective financial management gives you tools to chart your course into the future, adjust your direction when needed, and help you find your way through challenging times. If your business growth requires financing, financial management provides the information to know how much you can afford for your business. Financial management gives you not only the documentation needed for a loan application, but also helps you discuss your business circumstances with a lender in terms that improve your ability to qualify for the loan. Gone are the days where the books for your business are stored in paper ledgers. Today, even the smallest business can afford and benefit from business accounting software. The accounting software you choose can give you insight into your business that old paper ledgers never could without deep analysis. Choosing the correct one for your business is key. In order to be an effective tool for you to use, accounting software needs to be selected after good consideration and then set up properly for your business. There are a number of software options. Consider the following questions when making your choice. Would you like the software and data to live on your computer or be based in the cloud? Do you need your software to also run payroll? Do you, or will you in the future, need your accounting software to scale with you with add-in features like customer relationship management, point of sale, or inventory control? What additional features are required? What piece of software is widely supported in your industry? What does your CPA recommend? What is your budget? Once you've selected your business accounting software, it's critical to correctly build it to support your growth. It takes some effort to get your system set up, but once you do so, you'll realize the software's full benefits. Are you using cash-based accounting or accrual-based accounting? Cash-based accounting is an accounting system based on the actual flow of cash in and out of the business. Income is recorded when it's received, and expenses are reported when they're actually paid. Accrual-based accounting records income and expenses as they occur, regardless of whether or not cash has actually changed hands. This method matches the income earned against the expense generated, whether or not cash has been received or paid out, and always provides a clear picture of profitability. However, it does not provide an accurate picture of the timing of cash inflows and outflows. Choose a start date for your business. For a new business, it's the date that you opened your checking account or filed your business papers with the state. Set up your chart of accounts. Your software will likely have a standard set of general ledger accounts, also known as a chart of accounts, already set up, but you'll want to consider what else you need that's right for your business. Some of those special accounts might include inventory of goods for sale, fixed assets such as furniture or fixtures, other assets such as patents, trademarks, or copyrights, sales tax payable, what are the regulations for your state, county, and city, payroll taxes payable, notes payable to banks or other creditors, current portion of long-term debt, business credit card, equity accounts. Talk to your CPA about your equity accounts so that you can be confident that your financial statements are accurate. Pull together your customer and vendor list and enter them so that you have easy access once you begin using the system. Set up your forms for purchase orders, quotes, and invoices. If you'll not be the only one accessing your software, you may consider setting up permissions for other users. This will determine how much financial detail each user can see and interact with. It's a good risk management practice to have different levels of permission for each user. If you've been in business for some time and are converting your accounting to a new piece of software from a different method of accounting, it's best to make your transition at year-end. Consult with your CPA before you begin using your software to verify everything is set up correctly. It will be much less costly than having them come in later and have to adjust for errors. Creating a budget is the next step in your financial management practice. A budget is a list of all of your monthly or yearly expenses organized by categories. A budget is a tool that helps you track all your business expenses, plan for the future, economize when you need to, plan for expansion, and make a profit. Once you create a budget, compare it monthly with your actual expenditures. Bookkeeping is the organized process of tracking all income and expense transactions. Really, it's the day-to-day process of making entries into your accounting software. Bookkeeping is a critical component of financial management, which leads to better business decisions regarding financing, taxes, owner's draw, and retirement. Bookkeeping is a task that should be done on a timely basis. Setting aside time to make entries on an every other day or daily basis will give you the time to focus, which minimizes errors. We cannot overemphasize the importance of accuracy and timeliness of entries. Here are the basic bookkeeping steps you should be following. Record your daily receipts and expenses, including sales tax. Deposit all sales. Using the duplicating deposit slips, deposit all sales in your business checking account. Alternately, remote deposit capture, or RDC, may be available for depositing checks. Total sales should equal total deposits. Do not spend cash sales. Link all forms of sales documentation, such as invoices and cash register tapes, with a specific deposit. Pay your business expenses with your business checking account. Don't use a petty cash system unless you are experienced at bookkeeping. Review your accounts receivable and accounts payable aging reports on a weekly basis. Knowing when you expect to receive money and when you owe money and staying current to those commitments will help you manage cash flow over time. Run payroll bi-monthly if applicable, and remit associated taxes. Pay yourself with owner's draw. Owners should pay themselves by writing a check or making an electronic transfer from the business account to a personal account. If you are a sole proprietor, assign those draw checks to an equity account called draws. Run a sales tax report each month and remit taxes to the appropriate agency or agencies depending upon your city, county, and state laws. Run a profit and loss statement each month, also known as an income statement. Run a balance sheet each month. Reconcile your bank accounts each month. Review your budget to actual spending each month and quarter. If you think of bookkeeping as your day-to-day financial data entry, then accounting is the practice of analyzing that data to help you run your business. Only accurate and timely bookkeeping can support your accounting process. As a small business owner, it can be intimidating and confusing to know which reports to pay closest attention to. Understanding how to interpret your financial reports and what that means for your business is one of the most important functions of a business owner. Relying solely on others to interpret your financial reports will make it challenging to grow your wealth and can pose a risk management concern for the financial health of your business. If you're new to small business accounting, we recommend focusing on 3 main financial reports to get started: the profit and loss, aka income statement, balance sheet, and cash flow report. A checking account balance is not a good indication of how much profit the business has made or what amount is available for owner's draw. A profit and loss, or P&L statement, can provide a better picture of the financial health of the organization. A P&L statement measures revenue, also called sales or income, and expenses over a month, quarter, or year. With it, you know if you have made a profit and how much, or if you've incurred a loss. A P&L statement will reflect your business decisions on the basic buying and selling process. A P&L will tell you how well you're managing your business and provide information on how to grow your business. The basic formula for a P&L statement is this: sales minus cost of goods sold equals gross profit. Gross profit minus fixed expenses equals net profit. Let's define those 5 terms. Sales, also called income or revenue, is the total amount from selling your product or service during a certain time period. Cost of goods sold, also called variable costs, are those costs incurred as a direct result of producing or selling the product or service. Cost of goods sold may include cost for materials used, direct labor, manufacturing costs, packaging, and freight. Also included are fees from merchant services when your product or service is purchased with your customer's credit card. There are some types of service industry businesses that will not have cost of goods sold. Gross profit is what is left over after deducting cost of goods sold from sales. It's the money available to pay the fixed costs. Fixed costs are expenses associated with your ongoing business operations, such as rent, salaries, insurance, utilities, and advertising. Net profit is what remains after paying the fixed costs. Net profit is the source to pay for loan repayment, owner's draw, income taxes, and reinvestment into the business for expansion or equipment. Balance sheet. Now, the balance sheet shows what you own, called assets, what you owe, called liabilities, and what's left over, the net value or equity in the business. When a business buys assets, it pays for them with either borrowed money, liabilities, or equity, money kept in the business. The balance sheet numbers change each time you have a business transaction. Think of the balance sheet like a scale. Assets and liabilities alone are out of balance until you add equity. The last weight put on the scale makes it balance. A business that manages its liabilities and builds equity over time is considered less risky by lenders and better able to weather economic downturns. Assets are divided into two categories, current and non-current. They are listed according to how liquid they are or how quickly they can be turned into cash. Current asset examples include cash, accounts receivable, and inventory. Cash is the money you have in the bank. Accounts receivable is cash owed to you. Inventory is product you own that will be turned into cash. And non-current assets are furniture, fixtures, property, and equipment. Liabilities are what you owe and are also divided between current and non-current. Current liabilities are bills that are due in the short term, generally within 12 months, such as what you owe your suppliers and vendors for your purchases. Long-term liabilities are bonds, mortgages, and loans payable over a period exceeding 1 year. Equity, known as net worth, is what the shareholders own as a bottom line. This can be profit that remains in the business and also money owners have invested in the company. It's simply figured as total assets minus total liabilities. Cash flow projections. A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of a business over a future period of time. A cash flow projection is used to see if projected cash receipts, inflows, will be sufficient to cover projected cash disbursements, outflows. In other words, a cash flow projection is a tool to help you manage your cash so you can pay your bills on a timely basis and keep the doors of your business open. A cash flow projection is a great tool for setting sales goals and for planning for expenses to support those sales. It allows you to see an upcoming cash shortage and proactively plan to solve it. If you need to plan for a large expenditure, such as an equipment purchase or move to a new location, a cash flow projection is the perfect tool. If you have a seasonal business with large inventory purchases, a projection can help you have the cash on hand to make a large inventory investment when you need it. A P&L statement can mask cash shortages if you use accrual accounting. A cash flow projection helps you see the cash status of your business now and plan into the future. A cash flow projection is a good way to prepare and plan for your financing needs and is often a required part of a business loan application. There are a number of decisions a business owner can make that can impact cash flow positively. Each of these decisions should be informed decisions based upon your market, customer base, and vendor relationships. Some examples are: increase the number of items you sell, increase the price, reduce your expenses, change the timing of expenses, obtain sources of cash other than sales, such as line of credit to use during seasonal dips in sales, reduce or change the timing of your owner's draw, research vendor options for buying inventory at lower price or obtaining credit from vendors, establish policies to get paid sooner from customers. It's common for businesses that struggle with cash flow to turn to credit cards to get through slow periods. This is a slippery slope and we do not recommend this practice. Rather, understanding all of your financial reports, developing discipline in reviewing them, and working with your CPA or financial advisor will help you manage cash flow long term. There are a number of reasons why businesses fail, and many of them are due to a weakness in financial management. Here are the top reasons we see businesses struggle and even close their doors. Insufficient capital, poor cash flow, growing too big, too fast, lack full understanding of market needs and competition, lack of planning, getting the right help through staff or outside sources, poor execution and internal controls, not pricing properly, lack of sales or promotion, lack of ability to adapt and innovate. Remember, good financial management is based upon the following principles. Select and implement accounting software that's right for your business. Develop a budget that is reasonable and inclusive of all your expenses. Make sure you are reviewing and adjusting as your needs and goals change. Develop a discipline around timely and accurate bookkeeping practices. Learn to review and interpret your financial reports on a monthly basis. P&L, balance sheet, and cash flow report.
Cash flow is always an issue, I think, especially in our Northern Michigan economy and the seasonal cycles. E-commerce, I had always wanted to incorporate in the business. I started my first year in the fall opening up the e-commerce, and it took a little bit, but slowly the e-commerce business grew, and it really did help even out the cash flow. Months are hard in the late winter and especially the early spring, and the cash flow from the e-commerce site really does help pay the bills in those months. The e-commerce business is really, depending on the month, about 1/3 of my total business. Also, it really helps maintain customer loyalty where they can shop here in the store in the summer when they're here, because we depend a lot on our resorter customer base. And then they can also shop with us in the wintertime with ease and tell their friends, in Florida, that sort of thing. So they really work in tandem together. And I think in the next few years, you'll even see more growth with that.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more, because it's not profit for us, it's prosperity for all.